Thanks.
Geopolitics is one of those things. I've said it before. I'm going to say it again right now. It's one of those things that markets, at least markets here in the U.S., don't seem to care about until they have to care about it. Why could now be one of those moments?
Well, that's correct, because in fact, this goes back to over 100 years that when the First World War broke out, the markets were caught completely unawares by that. So the markets don't really have a good read on geopolitics. But I think that neither do geopolitical experts, for that matter, because after all, when the war broke out in Ukraine, all the geopolitical experts told us just before that Putin would never invade Ukraine. So some sort of slack here for the markets. Next week's events, I think what we can say is that it shows you about the big disconnect between America's economic power and financial power, and yet its geopolitical power now. That here is China that's been able to broker peace in the Middle East. It's trying to play a much bigger much bigger role on the global stage. And yet, as far as America is concerned, it finds itself get sidelined. But when it comes to monetary policy, the Fed, financial markets, everyone still looks up to America. So this big disconnect really between America's financial might and America's geopolitical might now.
How does the banking crisis that we're seeing unfold in real time play into that? And I ask that because we've seen the dollar weaken this week. And yes, we could talk about bank failures in the U.S. being regional in size, but then, of course, you've got all the question marks around Credit Suisse in Europe as well. How does that fit into this bigger, broader picture about this disconnect that you're talking about?
I think it's a very important point because events change very quickly, but I think it's quite significant what you pointed out, that the dollar has not been able to rally as much as you would have expected it to, given what's going on, because everyone thinks of the dollar as a safe haven. And I think this is a big change from what we have seen in recent years. And that's partly because what's been slowly unfolding over the last few years, and especially after the what U.S. did in terms of sanctions against Russia, that a lot of countries, whether it's China, it's India, they're all trying to diversify, get off the dollar standard. They understand that the world has become too dependent on the U.S. dollar, and they've been trying to get off that standard, trying to cut bilateral deals, trade more with each other in their own currencies. And countries like China have been diversifying and buying bonds of other countries, from Indonesia to Europe, everywhere, except in the U.S. So I think that that's what's going on, that we are moving very slowly to a post-dollar world. There is no clear alternative to the U.S. dollar. The Chinese currency certainly is not. But you're seeing attempts at diversification. For a while, even controversially, crypto held out that promise, which went bust. But again, interestingly, crypto has done relatively well over the last few weeks. So I think we are very slowly moving towards a post-dollar world. The dollar became very expensive, and America has been taking it for granted. And so I think that over the next few years, you will see a much weaker dollar than what we have today.
Okay. Focus now is on the Fed meeting next week here in the U.S. Your expectations for another rate hike, and also, it's not just the Fed who's raising next week. We have a whole flurry of central banks. How do you think all of this is going to fit together and speak to the global liquidity picture?
Well, this is the really big difference, right? Because in the past, when you ever had even the hint of some financial crisis or some vulnerability, the Fed would immediately pivot and ease monetary policy quite aggressively. They started doing that in 2007 at the first hint of trouble. The big difference is that for the first time in 40 years, we have some sticky inflation this time. And I think that central banks cannot just ignore that. So therefore, it's hard for the Fed to completely back away from raising rates next week and at least do a quarter-point rate increase next week. I think that's pretty much baked in, and that's what we're likely to get. And they're going to try their best to separate the objective of financial stability from controlling inflation. I think it's very difficult to do. There is a price to be paid for these years of easy money that the Fed has followed. But for now, they're going to try and firewall the two. So I think that we do, go ahead with the rate increase, just like the ECB went ahead with the 50 basis points that they expected. And then until we actually see inflation come close to, like somewhere close to the objective. I don't think we ever get to 2% again, but somewhere close to that. I think it's very difficult for central banks to just declare victory or completely pay too much attention to what's happening in financial markets, because this is the big difference. This is why the markets are still so nervous. And despite the headline averages appearing to hang in there, beneath the surface, there's so much damage which is happening there. And the markets are really not behaving in a healthy manner just now.
Ruchir Sharma, appreciate you joining us on a day like today in a week like this.